Nike stock is down about 6 percentage points after hours. Earnings came out. We're going to discuss these earnings. We're going to look at the numbers around Nike here. I'm going to give you my perspective and opinion on these numbers, the guidance, all those sorts of things. We'll discuss that in this video here today. Then I want to react to this video. This is an analyst opinion on Nike. So looking forward to reacting to that one, sharing my opinions and perspectives if I agree with him or disagree with him. Then we're going to get into a little more market talk here. Bull market won't be derailed, says Rockefeller's Chang. So looking forward to getting into that one. It's Nvidia's game to lose in the semiconductor competition. Looking forward to Stacy Rascon, his opinion on Nvidia here, and share my opinions and perspectives. For every day striking, there will be 7 to 10 days of port congestion. This is going to be a very interesting video to react to here from the Flexport CEO. And the reason being is obviously, I'm sure you guys are aware, they're striking out there right now. And so I want to kind of give, I know I saw a lot of comments about like what my opinion is. Is this like a black swan event for the market where if this goes on for a while, we could actually cause a lot of disruption in regards to the overall economy that could send the market substantially lower and have companies miss earnings. So we'll speak about all that in this video and all that good stuff. Okay, so appreciate y'all joining me as always. Thank you so much for being here. Thank you for smashing that thumbs up button, and thank you for being subscribed here to the channel. Okay, alrighty. So, and by the way, as far as pinned comment down there today, I'm gonna put my X and I'm going to put my Instagram. So if you don't follow me on Instagram or you don't follow me on X and you're interested in following on either, you can follow me on there. On Instagram, I post quite a few Instagram stories on almost daily basis, bunch of different stuff. And then X, I'm pretty active on there nowadays as well. So if you're interested, I'll put those pinned comment down there. So Nike, I do have to point this out because it matters, I can say a lot to the market. Okay, here's the deal. Here's a real deal, Holyfield. Nike missed on revenue, but it was a very small miss. However, they did beat analyst expectations on earnings per share quite substantially. So the overall, from that perspective, especially given that Nike stock's been in such a tough place and given that there's a lot of negativity already around Nike stock, I think that's what's actually keeping the stock relatively in a decent place, because you got to keep in mind, they just took guidance away. Which, does that make sense to take guidance away? Absolutely. You got a new CEO coming in. Why set him up in a bad position? Take the guidance down, have the new CEO figure it out. That's the most intelligent decision they could have honestly made in regards to the situation. But usually if a company takes away their guidance, the stock goes down double-digit percentage, like huge, right? And Nike's actually decent, it's not like it's that painful. But like I said, it's because the stock's already priced in so much dang pain. Numbers, bad. Just bad across the board. Revenue's down 10%. Cost of sales was down 12%, so they actually did keep their cost of sales down in a very good place, their COGS there. Gross profit was down 8%, which is not ideal. Like, you don't want to see your gross profit ever going down. However, if your revenue's down 10% and your gross profit's down only 8%, that means, basically you're getting some leverage actually in your cost of sales, which is, I could say that's somewhat optimistic, because they will, as long as you're confident they're going to turn around their revenues, right? If you're confident the revenues just go down forever, that's a whole different situation. But as long as you're confident the revenues come back, which I am, right? Then, the business model is going to be set up in 2025 and beyond for some crazy profitability increases, essentially, margins to go up substantially and earnings per share as well. Demand creation expense, oh my gosh, that went up 15% year over year. Huge uptick there. However, that is Nike's bread and butter. That is their bread and butter. And that's why Nike stays relevant generation after generation, decade after decade, and why these other brands fall off, which they all do, and they all will. They all do, and they all will. Study, go a little bit about history in regards to shoe space, the apparel space, and you'll find every hot brand always fades. The only one that remains, is Nike. Only one. And it's because they spend a stupid amount of money on just getting the best athletes in the world and advertising like crazy. And at the end of the day, it's a winning formula. And that's why Nike will win the next 10 years and the next 20 years. And my kids will wear Nike and their kids will wear Nike. And that's going to be that. While these other brands, just fade off into irrelevance again and again and again. It's been like that for the past 40 plus years. It will continue to be like that. Operating overhead expense was down about 7%. They're continuing to bring that number down. I think that's going to continue to come down in the short term, so that's good news for the company. Total selling and administrative expenses was down 2%, so that's somewhat in the right direction there, right? Income before income taxes down 21%, net income down 28%, diluted EPS down 26%. This is a grade D income statement here from Nike. As far as balance sheet goes, basically no real movement in shareholder equity here. Cash equivalents was up substantially, but short-term investments was down. Net, there's still, I could say cash and cash equivalents increased by about 2.3 billion, where short-term investments only went down about 800 million. So big substantial difference there. So as far as Nike's balance sheet, good. It's in a good place, right? And then this is important here as far as North America. Revenue's down 11%. Greater China's down only 3%. I think that's a win for Nike. Only down 3%. And now China has all the stimulus coming in. I think actually Nike sets up really good in 2025 in China. Very, very good. So I do think that's important there, right? And then, as far as footwear and apparel, I think those will turn around in 2025, which is going to be great news for the company. Now, I think this is a little bit like a Tesla situation in terms of I don't think people quite understand what's going on here in regards to Nike. They don't have the right frame of thought, and they're going to get exposed to the right frame of thought over this next 6 to 12 months in regards to this. But Tesla was very misunderstood in terms of their real weakness in their business, through 2023 and then into the beginning of 2024, right? And people looked at Tesla and they didn't understand. They're like, all these other auto manufacturer numbers look great, but Tesla's numbers are horrible. They didn't understand you got to go deeper than just like, this quarter reported this. In regards to Tesla, you got to understand Tesla sells directly to customers versus traditional business model sells into dealerships. So there's going to be a 6 to 12 month lag. So if Tesla's numbers are bad, 6 to 12 months from now, you see the other auto manufacturers. And what's exactly what you've seen, right? What's exactly what you've seen? Tesla got hit first, and now all the other auto manufacturers are all up in arms saying we got problems left and right. Every single one of them is all of a sudden having issues, right? On either the revenue side or the profitability side. And most of them, it's on the revenue side. And now they're all warning left and right, right? Is a lag there. So in regards to Nike, how is that similar to the Tesla situation? Well, people don't understand that some of the other brands that have been doing decent, you got to understand those specific brands sell to, let's call it the upper middle class, okay? So Hoka, some of those brands that are on right now, and then they're going to be gone and irrelevant 5-10 years from now, those brands have done well recently because they sell to mainly a customer base that's higher income, right? Nike sells to everybody. Like they sell to folks that have minimum wage jobs. They sell to folks that are multimillionaires. They sell to everybody. Everybody's Nike's customer. And so Nike got hit way before these other companies have gotten hit in regards to their numbers because everybody's their customer. And so if you have consumer confidence in a horrible place and people just don't have the money for a new pair of Jordans, they can't go buy a new pair of dang Jordans. How hard is that for people to understand? They don't get it. They will get it though. They will get it. And so that's going to happen over time. And then they'll see it and their eyes will be open. Like, oh my gosh, I never understood this. You've got to understand business on a deeper level. The problem is people don't understand business. They don't understand it on a deeper level. They don't do any study. They don't do any research on these subjects. And so they just kind of just look at the raw numbers and like, this good, this bad. It's like, dude, you got to wake up at some point and you got to realize it's deeper than that. And so the moral of the story is Nike will be fine in the end. And stocks end up making me a lot of money. And this is an easy buy the dip opportunity in regards to Nike. I'll be buying the dip certainly. And that's that. Let's hear this analyst opinion.
Heard from Sarah, especially with gross margin improvement, the North American revenue basically in line, China revenue a little bit better than expected, and a beat on the bottom line and a miss on the top.
Yeah, look, I think it's a great rundown from Sarah. So, in the numbers that she ran through, as she was talking, I was reading the release as well. I mean, that's very much, I want to make sure I say this correctly, an in-line, a fiscal Q1 that was in line to better than dampened expectations. Okay, so what we're seeing there is, yes, sales are weak, but as expected. Well, I think China, very fluid situation, that's probably somewhat of a positive. And then, what we're seeing again is even at these lower levels of sales, Nike does have enough, so to say, levers in its business model to beat earnings pretty handily. So that's a positive. Now, the comment from the CFO, look, I think that's a positive. We've been hearing this from Nike, and that is what they're basically saying is, look, where we're touching product, where we're introducing new product, that product is selling well. It's just in the very early stages of happening. But I very much take that as an indication of what we should expect from Nike, over the next several quarters as they get more aggressive on this product innovation front.
So the fact that
kind of like McDonald's numbers, certainly haven't been very exciting for investors. But yeah, you go to Cheesecake Factory and there's a line out the door. You go to North Italia, there's a line out the door, right? But you got to understand, cheesecake in North Italia is selling to a higher income bracket than, let's say, McDonald's is, right? Everybody's McDonald's customer. Like, you could have a $10 million net worth and go get a Big Mac at McDonald's, and somebody that makes minimum wage can go get a Big Mac, right? And so that's kind of a Nike situation here. And, people just got to understand the inflation that we've really felt over the last 2 to 3 years. It hits the lower the income, it hits harder those sorts of folks than higher income.
Shares are now trading negative. They're down, looks like about 1.5% right now. I mean, any sort of sense on why we would be seeing that reversal? Is this because of the postponement of the Investor Day?
No, look, honestly, I think that the trading right now is largely noise. Because I think the real key factor is going to be what they say about guidance, and they'll do that on the conference call. The Investor Day, that's on Wall Street. We've been watching this. I think it's been pretty well expected that they would postpone that. And frankly, that makes a ton of sense. The new CEO's coming in here in a couple of weeks. We got to give him time to get acclimated, even though he's historically from Nike. You want to give him time to get acclimated before they go present in some significant way to either analysts like myself or investors.
Brian, to what degree do investors risk overdoing it on the negative narrative around Nike? I think back a couple, 3 years to what was bubbling around Meta. Oh, they changed their name at the wrong moment. Their business model is broken. It was right around the time when the iOS ad changes were going through for them. And boy, did it bounce off of those lows that it hit at the peak of disillusionment. What are we looking at here for Nike? How much will it take in product changes and time, do you think, to achieve a turnaround here?
Well, look, I think that's a great question. Okay, and I'm recommending Nike. I know I'm early. Okay, but what I'm saying to our clients is, and this is a great response to your question, John. Look, let's not forget, this is Nike. Okay, Nike's one of the most dominant brands on the planet, maybe in history. Okay, they've made some mistakes. They've allowed other competitors to come in and take market share selectively. But this is Nike, and I very much believe that as Nike has recognized its shortcomings, recognized its mistakes, and now with new management coming in, new proven management, I think that this company could very much get back on the right track and change that narrative relatively quickly. I think that's really one of the biggest risks from a market perspective is that investors are too quick to write off Nike. Nike's a broken business. I don't think that's the case. I think this is still a very strong brand, both in the United States and globally. And I think they just need to correct some of the mistakes that were made over the past, say, few years or so.
And I guess to that point,
and the best thing for Nike, is now they get to comp against these numbers next year, and then comp off those numbers. So next year, even if they show a few percent growth, that's going to be substantial for the company, right? And then the following year, show more growth on that. So now the company's set up in such a great situation when it comes to comp profile for 2025 and 2026, right? So everything's kind of playing out here exactly how I want it to play out, and this is why I'll just be buying every share in sight. I'll explain one more thing in regards to Nike in just a moment.
When you start talking about saturation of some of these brands within the brand, like Jordan's, Hill was part of Nike's leadership team when the company had to make a similar inventory reduction or correction, if you want to call it, back in 2017. So the fact that he has a track record, can we look to that as a historical example of how this could play out?
Absolutely. I think this is we have not heard really, from an investment committee, as far as an investment committee, to my knowledge, we've not heard really anything from Elliott significantly, since he's taken this role. But I think it's a very, very good move on the part of the Nike board because you're bringing back a proven executive, that had a great deal of success at the company, and also from everything I hear was very much liked within the company. Because again, there's also a culture issue here. Nike's a big culture company. It's had a great culture over time. I think bringing back an executive like this is going to help that culture.
I want that culture feeling. So, in regards to Nike here, as far as the stock price goes in the short term, it doesn't set up great in the short term for the stock price, right? And when I say short term, I'm talking the next 30 to 60 days, right? You kind of have this weakness out there. If the market continues to be weak, that weighs on the shares. And then you're going to have what? You're going to have tax loss harvesting. There's no doubt about this. Tax loss harvesting coming in Nike in this fourth quarter, right? And so how heavy is it? We'll see. You never know. Could it push the stock down to 82 or 80 or below 80? It's a possibility. So you're going to have tax loss harvesting. It's just a question of how much do you have. And remember, Nike's a big stock. It's not like it's just retail investors that own Nike. It's actually hardly any retail investors own Nike. That's a big stock when it comes to funds, institutions, right? So when those folks go to sell, they're pretty big sell orders, right? And so that's going to weigh on the stock in the very short term, which allows somebody like myself as a long-term investor to come scoop up these shares while the sentiment's very down and out and so negative, blah, 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 right? It's the end, it's the doom. And then in a few years from now, Nike's going to be 200 plus again, and people are going to say, oh my gosh, it was so easy. It was such easy money. Like Nike, how did I miss Nike, right? Because you've got to understand the way the business model is set up now. You're going to have the excitement of the new CEO coming in. That's going to be very exciting for 2025 and beyond, right? And then additionally, and a guy that's already liked in the culture in Nike in a massive way, he's one of the most liked people ever at Nike, if not the most, right? And then you have an expense profile that's going to be in a great situation for 25 and 26, right? And so you're going to see the revenue start to come back in 25, 26, and then you're going to see margins expanding simultaneously and the earnings per share going to the moon over the next couple of years. And so it's going to be very exciting. I think it's going to be a very exciting time to be a Nike shareholder, 2025 and 2026 specific. And so anyways, people can get all doomsday or do whatever they want to do. I'm going to be making a whole bunch of money over the next few years in that one. Bull market won't be derailed.
Middle East affairs. You are certainly not unfamiliar to how geopolitics affects the investor psyche and affects investment planning. When you have something like this that for a lot of people was a surprise, what is sort of the first thing that you look to in terms of telling your clients, your colleagues, your peers to do next?
Well, the important thing is to separate the noise from signals. And I think unfortunately, or perhaps fortunately, and I don't mean to sound dismissive, the markets have been conditioned in the last few years to react temporarily to these issues. They will bid up safe haven prices, gold, oil, treasury prices. But then as soon as they get the all clear signal that things are under control, they'll put it behind them and go back to whatever they were doing. So long we don't get further escalation in the coming days, I think the market will look past it. Now, one of these days, it will be proven wrong, because I do agree something has to get worked out in the long run, and the conflict seems to just be escalating.
I am curious about the cumulative effect of various sort of wars and other conflicts. Obviously, you have what's going on between Iran and Israel. Obviously, the Ukraine-Russia war continues to go on. You have other big geopolitical disruptions going on around the globe, not to mention a changing of the guard in terms of presidential elections around the globe that are really going to reshape foreign policy. This is much different right now, what we're seeing, than maybe what we've seen in past cycles here. How do you adjust?
I think you want to weigh the different issues. I think at least in the near term, I think the bigger catalyst is the U.S. election. If you have a Harris administration with a Republican-controlled Senate, that will be viewed as largely status quo. If you have a Trump victory, I actually think that's going to be very disruptive as far as the foreign policies, pertaining to the war in Ukraine, support for Israel, whether it gets, more assertive, and also the tariffs issues. So potentially the election can turn out to be more disruptive.
In terms of just the U.S. markets and how they respond to these exogenous events, I think about what happened with China, the week-long stimulus package that they announced, and how little impact it had on the U.S. market overall in terms of lifting sentiment and really inspiring people to go outside the U.S. And then you have the news today with Iran attacking Israel. And yes, there's certainly a movement in stocks and in oil, but if in the long term people are going to look past it, what is it about the U.S. market that has its participants looking inward as opposed to digesting the headlines from outside?
I don't know if I agree with what he said there about if T-Man is in office, things are going to be more uncertain in regards to that. I don't know if I feel that way, to be honest. I think he knows how to talk to a lot of these folks in a good way. And the other good thing about him is He's a little bit unhinged. I think everybody can agree on that, and everybody knows that. And because he's unhinged, people are actually, I think a lot of these other leaders actually do fear him. They might not like him. They might think, he's whatever, right? But at the end of the day, I do think actually they fear him a little bit because he's, if you have a typical person in there, you know what they're going to do. Like, you know how they're going to react. Like, if Harris is in office, you know what she's likely going to do. You know the decisions she's likely going to make in regards to dealing with these other countries, right? T-Man, you don't really know. Like, he's a little wild. Like, he's a little crazy, right? And so if you're another leader of another country, you kind of fear that. You're kind of like, crap, man. Like even if he sends a threat, you kind of start to have to think like, because he would send a threat that no one else would send, right? And then you got to start considering like, does he mean it? Like is he for real on that? Like maybe he is. Right? And so I don't know. Like I just don't know if I agree with him in regards to things would be more uncertain. They might actually be more certain.
I think over the last 10 plus years, investors have been conditioned to overweight the U.S. So we tend to dismiss what happens overseas. In fact, you hear a lot of people saying that China is just uninvestable. And then last week, we get a sudden surprise with a pretty strong stimulus on the monetary side and also the PBOC lending money to companies and investors to buy stocks. So you get a nice pop in the Asian market. So temporarily, that could mean our performance by emerging markets. But again, the election could be disruptive because depending on the tariffs policies, right, that can...
The tax seems to be ineffective. That could be on purpose too. It could be more to send a message than anything.
Again, disrupt the emerging market rally.
How much are you seeing your clients ask you about the election? Because you point out all these different scenarios, but we might not get an answer until as late as January.
Most people are obviously interested, but we tend to have a very long-term view. So the strategic allocation has not been altered. In the meantime, tactically, you could play out a different scenario. So, for example, if you have a blue sweep, I think the market will probably view it as somewhat negative for equities and positive for bonds. If you have a red sweep, that's potentially more inflationary, so it's negative to bonds, but then equities may do well on the belief of deregulation, potentially lower taxes. If you have a slick government, it's probably a muted impact.
I am curious, though, we talk about some of the tailwinds for this market heading into this election. Interest rates finally coming down, an economy that's at least doing better than I think what people had anticipated here. No matter what the outcome of that November 5th election, is it possible that those tailwinds could outweigh any potential negatives we get from the election itself?
Right now, the thesis is synchronized global easing, with the exception of Bank of Japan. I counted in September, we've had 25 rate cut announcements across the globe. So people will
Since September, 25
across the world. So that's the thesis. But then if you have a Trump victory, potentially driving up inflation with new tariffs, potentially higher economic activities, would that then disrupt the rate easing, the interest rate cutting cycle that the market is pricing in? So I do think potentially there could be some risk to the Treasury market.
Are you concerned at all about some of the other risks that have been bubbling up? We have a port strike that just started today that could have significant economic consequences should it drag on for weeks rather than days. We have another strike over at Boeing that's still unresolved, as well as a lot of other issues that have the potential for an inflationary impact as well as an economic impact.
Yes, I do agree. These are really good points, depending on how long they last.
That's true.
There is an impact on inflation, and that could potentially disrupt the market's complacency about the interest rate cutting cycle. And at some point, inflation could still make a comeback once everything settles down, especially with central banks being so aggressive on the easing side.
As much as you say that investors are conditioned to look past these headlines, these hiccups from overseas, are these latest headlines enough to at least derail or snuff out the bull market? I mean, are we done with making new record highs?
Well, given that we've done so well in the second half of September, so a little bit of pullback is normal. I don't think it's enough to really derail the bull market. So anything, maybe a 5% pullback. And then the focus in 2 weeks will be on the earnings season and then the elections.
The funny thing is, there's been so much crap the last 2 years, right? Like, so much crap. Like, Fed raised rates so high, they kept them up there for so long, right? And you have all this geopolitical problems, you have multiple wars and multiple fronts, you have so much stuff, right? And yet it has been such a great time to make money in the market with all the uncertainty, with all the problems, so much money to be made. The thing that kind of worries me is eventually we're going to get to more normalized times again, and it's going to look like smooth sailing. And that's when everybody, when I say everybody, I'm talking about like the retail folks are really going to enter the market in mass. And that will be the time the stock market drops off the cliff. That will be the moment when everything looks like coast is clear. Oh, everything's great again. It's calm waters. Go ahead, get in. That's when the freaking hurricane hits, man. And the next thing you know, like the whole market just dumps hard, right? It just, oh gosh, because you've got to think like there's been so much crap the last 2 years that has really transpired. That could be looked at as negative. This is negative. This is negative. This is negative. And yet at the end of the day, oh my gosh, could you imagine not being in the market let's say you sold your stocks 2 years ago, right? You're like, oh my gosh, inflation's still a problem. Interest rates are insanely high. They're going to keep them high for a long time. It's going to be bad consumer confidence. It's going to be bad business sentiment. It's going to be blah, 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 right? All these issues. I mean, can you imagine the amount of money you would have missed out on? Like the public account 2 years ago, was probably 1.1 million or maybe 1.2 million, somewhere like that. If I go back 2 years ago today, the public account's $2.4 million now. If I would have sold all my stocks 2 years ago, I would have, maybe 1.1 or $1.2 million right now, right? And I'm sitting on that cash. You say, well, I could have earned interest having it at 5%. Well, yeah, still, it wouldn't have been that much additional money. Versus I have $2.4 million in that portfolio now, all with minimal contributions. So, my gosh, would that have been a mistake? And sure, I would have been right about, wow, there's so many problems in the world. There's so much to be concerned about, so much to be scared about. But I've been 100% wrong to just missed out on a ridiculous amount of money. A ridiculous amount of money. Crazy. 7 figures plus. And this was in that one portfolio. Never mind if I did that across all my different portfolios, right? One portfolio. 7 figures. That's wild. Next one up here is NVIDIA's game to lose in the semiconductor competition.
More broadly, top chip analyst, Bernstein, Stacy Rascon. And welcome back. It's nice to see you. So I know it's too soon for you to talk about this company specifically, but at least it raises the issue of companies that are out there that want a piece of this AI pie. How should we be thinking about these newcomers relative to the heavyweights like NVIDIA?
Yeah. So there's a number of areas of competition for NVIDIA, which makes sense. It's an enormous potential opportunity, and all the dollars right now are flowing to NVIDIA. And you've got other merchant suppliers like AMD or even Intel. You have hyperscalers doing their own products, and then you have startups as well, right? And I think for a lot of the startups, it's difficult. They don't have scale.
Yes.
They don't have ecosystem. And if their pitch is, we have a chip that's better than NVIDIA, I think that's hard because, with every generation, NVIDIA has a chip that's better than NVIDIA, and they have the software and all the ecosystem support that goes with it. So I'm not going to comment on Cerebras, but they're doing some other things. I mean, clearly, they're gonna try their best at this point. But in general, so far it's been a winner take all. And I always, I've said this before, it seems like it's NVIDIA's game to lose, like more broadly.
Well, I mean, it's winner take most, right? I mean, it's not like Broadcom hasn't done well. No. The issue, though, is that, as it's done better, its multiple's gone up, hasn't it? So it's not as cheap as it was viewed to be before.
That's true. And so to be honest, if you're talking about like the real competition, I actually think it is more on that hyperscaler side. The cloud vendors doing their own chips, and this is an area clearly where Broadcom really shines. They're doing a lot of the ASIC work for the key players like Google and Meta and some others. And it's a very big business for Broadcom. They said $12 billion in total AI revenues this year. I bet $8 billion of that 12 is probably custom AI accelerators and ASICs for those large guys. And look, I actually do think that is real, and it will get bigger. And I wouldn't be surprised if the penetration of ASICs relative to the broader TAM gets bigger and bigger over time. It's kind of apples and oranges in some sense. It's more, those stuff is more used for the internal workloads of the hyperscalers versus workloads where you need programmability or anything that's customer facing or enterprise. So they are kind of two different markets. But yeah, I mean, this is a market that's already sizable and it's getting bigger. But to be fair, I think that the overall opportunity, the TAM is big enough for both of them to benefit. I don't think it's a matter of one necessarily winning over the other. The market's sizable enough where I think both of them can win. And I like NVIDIA and I like Broadcom. We like both stocks.
I mean, but that kind of squeezes out AMD, doesn't it?
Well, I mean, this is one of AMD's like broader issues. I mean, in the near term, and by the way, they have an AI event coming up in a week or two, and we'll get some new product announcements, and we'll see. And they suggested they'll do $4.5 billion or more than $4.5 billion this year. I think expectations are probably for 5+, and I don't want to knock them too badly, because it was zero a year ago. I've said this before. So on an absolute basis, ramping up, $5 billion of a product from zero in a year is nothing to sneeze at.
True.
In the grand scheme of the dollars that are getting spent, though, it's not very big. NVIDIA will do well over $100 billion in revenue this year. Again, Broadcom's going to do double digits in total AI revenues. So it's not that big, but it's good. But long term, I mean, you bring up a good point. Like, I understand the need for a second source, but most of AMD's exposure right now is at these larger hyperscalers. And is that second source, does it need to be the AMD or is it Broadcom? I think that's an open question at this point, yeah?
Two quick ones before I let you run. What's the outcome, the end game, whatever you want to call it, for Intel? What happens here?
Yeah, I mean, that's a great question. I mean, they've kind of bet the company now that their 18A, their next generation process that they call 18A, they're betting the company on its success, and so that's I guess what we're waiting for. And if it is truly successful, maybe you could see a revitalization. They bring a bunch of, they're outsourcing a lot of stuff to TSMC right now. It's killing their margins. You bring the stuff back in, the margins get better. Ideally, it's a better process so they can take back market share and they can charge more because they're better products, and it gives customers a lot of confidence to put a lot of foundry volume there. And that's how you kind of build to the targets that they put out there for 2030. And keep in mind, it's only 2024 right now. There is a lot of wood to chop, though, between now and then. And if that process does not knock it out of the park, if it's not successful, then, there are some more severe scenarios that may come to play. And to be clear, I don't think they're desperate at this point. We've made this point before. I think given the OPEX cuts and the CAPEX cuts and the dividend suspension and the government funds and the private equity funds that they've gotten, I think their cash position is okay. So I don't think they're desperate. They don't need to make any crazy moves, but they probably got a year, 18 months, to see if 18A really holds muster or not. And if not, then there are more severe scenarios that may come to mind.
Oof, brutal. Yeah, it's we'll see. All right, next one up here in regards to strike at the ports.
Maine to Texas went on strike today in a dispute over wages and automation after rejecting a deal with the U.S. Maritime Alliance that would have raised wages by nearly 50% over 6 years. Well, joining us now is Flexport CEO Ryan Peterson. Ryan, it's good to have you on today. You really, in many ways, are kind of on the front lines in terms.
By the way, I got to say, the guy that runs the union for these folks, man, I got to say, he did, in my opinion, one of the worst jobs in terms of if you're trying to make people pro-union. I think he did one of the worst jobs. I think 90% plus of people watched that and were like so turned off. I don't know if he has never been PR trained or whatever, but the way, I don't know if you guys even got to see the interview he did, but the way he framed it is that he's going to crush the average American worker, right? And the way he describes everything was so horrible. Like, oh, they're not going to be able to sell cars, so they're going to be out of jobs, and the construction workers are going to be out of jobs. And just the way he framed it, that he's going to crush like the everyday man. And it was just so poorly framed on his part, in my opinion, that it was a type of thing that, like I said, I think 90% plus of people would listen to that interview and hate unions after that. And so he did not frame it in the right way at all, in my opinion. When you start threatening the everyday man that you're going to put him out of work because your workers want 50%, 70% raises, and these guys already make a lot of money, I'm telling you, man, it turns off a lot of people from unions. I can tell you that much.
What this means for freight flows and what this means for activity at ports. And we haven't seen a strike on the East Coast port complex since 1977. But we have seen work stoppages back in 2002 on the West Coast. I just wonder, based on history, how you would expect this to play out.
Yeah, there's a lot of uncertainty here. It's difficult to say exactly how this plays out. My expectation, I give it like a 70 to 80% chance that the two parties can resolve this week. But I think that if it goes longer than that, it might go a lot longer and be very ugly. For every day of strike, we're sort of looking at 7 to 10 days of congestion, of bottlenecks and backup of cargo. So you can play that out. If it was the last month, you'd be talking about 10 months of congestion, the likes that we haven't seen since COVID.
So when I hear you put that timeline out there, it raises the question. We know President Biden has basically said he's not getting involved. He's not going to invoke the power he has to get involved with the Taft-Hartley Act here. But is there a point at which this becomes too painful and that change?
Oh, 100%. A few weeks from now. A few weeks. If this goes on a few weeks, oh, yeah, big dogs are going to get involved. Trust me on that. Just give it 2-3 weeks. Mm-hmm.
Changes.
I mean, it's very difficult for me to say what the political calculus is, but from an economic standpoint, yeah, I mean, the pain could be really bad. This is 50% of all the containers entering and exiting the United States. It's a huge factor for U.S. imports, not to mention all the car imports and exports that are going out of those ports. So it's just massive. If you cut off the U.S., sort of our circulatory system in the global economy, which is the backbone of global civilization, you can't just turn it off without all kinds of second-order effects and unpredictable problems showing up that we're really outside of our range of predictability.
So, Ryan, first of all, good to see you. What do you think this is really about? Because you point out most businesses could hardly sustain an up to 70% increase in the cost of labor. But the East Coast ports, I mean, if you want to get goods from outside of the country into like half the country, you kind of need to use those ports. They could pass the costs along to consumers, which from an inflation perspective isn't great. But why not just do that? What's this fight really about?
Yeah, I think ultimately it's going to be a fight about labor costs and how much these workers get paid. They're asking for us. It looks like they're asking for a 77% increase in their wages. The employers who run the ports and own the ocean carriers, they offered a 50% increase. So that's kind of the bid ask right now. And that's what gives me some confidence this will get solved. It's not a huge differential in what they're asking for. And it does get shared ultimately because there's no other choice for how to get these goods in. And it's the same wages going to affect all of the employers, all the ports equally, and therefore all the ocean carriers equally, that can just get passed right through. There's, in a competitive environment, if my wages go up, it doesn't mean I can just pass it through if my competitor's not increasing their wages. But in this environment, everybody's wages are going up, and therefore it all gets passed through.
Yeah, and so who pays for it? It's you. You pay for it, okay? Let's just make sure there's no such thing as a free lunch. If you ever went to Econ 101, that's one of the first things you learn. There's no such thing as a free lunch. So, if these workers get a 70% pay raise or 60% or 50% or whatever, just remember, you're paying for that. I'm paying for that. We're all going to pay for that, okay? So just always keep that in mind. No such thing as a free lunch. Money doesn't just come out of nowhere. And believe me, companies aren't going to take the hit on that, and they're going to pass it right down to us, okay? All right, guys, appreciate you joining me as always. If you want to follow me on Instagram, I'll put that as a pinned comment down there along with my X as well. Much love and have a great day.